TGIF, Paul. How are you? And Richard. Okay, everyone. So yesterday felt like Friday to me. How about you guys? I could tell you guys are all tired and you're young and there's no reason for you to be tired.
Monday
especially someone like Ryan. So what are you thinking here, Ryan?
A little bit of a pause, I think, today. I think the market's generally tired. It's been a bit of a crazy week, hasn't it?
Yeah, it has, and
not seen your screen yet, mate.
Oh, share screen. Okay, now you do.
Yep. Okay. Yep. There we go. You have to make sure that the pawn's off before you do that, don't you?
Yeah. So, another. What do you say about the dollar? Struggling a little bit. Nice recovery in the end today. I think Cayman was nibbling or something yesterday.
Yeah, he was buying into those lows.
Yeah, nice.
It's looking to potentially form a decent range if you just come out a bit to maybe the daily or 4 hour. Just come out a bit further. Yeah, so that sort of 127 up to the 131 highs. That could potentially see us in a decent consolidation range. That's what I've been looking for, something to develop.
Could we get one more high? What would cause it? I don't think yields are going to make. I don't know how you feel about looking at this chart. I know yields have come back, but quite a bit off the hot CPI numbers still. But they could. You could get another high.
We need to know. We need a good catalyst for that, I think. Where are we at the moment with Fed policy? We know what they're doing. We know they're hiking 50 bips over the next 2 or 3 meetings. Then we know they're potentially going to pause. So what's it going to take? If we see inflation rocketing higher from here, getting up 9-10%, then we get another round of Fed expectation buying, and we get yield shooting up because it shows that we haven't hit peak inflation, and the Fed are going to have to do potentially more. So like the Fed, we're into data watching, but while we get these levels, these highs and these pullback lows and the support, while we're waiting for that to happen, it gives us decent areas to trade. So, you watch those levels.
Yeah, the Aussie has given me a hint today, with the dollar index being off 2, you have Euro up 5 and cable up 1, right? And, Aussie up 40. So we're approaching this line. And I know, Blake believes that the low that we had could have been enough. Doesn't have to touch the line, but, I think we're now into, looking to buy Aussie. Blake calls this a generational low, right? So aren't we getting close to some type of fib level where the Aussie could begin to dig in its heels and
it could be. Does that look like a currency whose central bank is just about to start hiking?
Right. And good morning, guys. TGIF.
Good morning.
Ryan, did I catch this correctly? You got out of your Aussie?
Yeah, I folded it.
Oh man, they shook you they turned you upside down, grabbed you by the ankles, shook you upside down, dropped all those pence out of your pocket, and they got you out.
Yeah, I got myself out. No one got me out. I got myself out.
All right. So
that's the
but I got to ask you this, like looking at what Dale's pointing out, and yes, my argument is like, hey, we might have hit a generational low. I know you tend to trade the Aussie a little longer term. What made you think? Do you think it's going to go much lower than this, like where you can get an entry point maybe at 65 cents, or did you just not want to deal with it anymore?
I got out. My average was 72.30. 70 was my big number. Below there, I assessed a trade. It broke there. it kept going. 68, 80, I drew my line. I said, you know, that's enough. My trade is the RBA hiking. It was always, as you know, going against their, we're not going to hike till 2024 rubbish. That's proved right. But when the price doesn't meet the strategy or doesn't match what I expect from the strategy, I've got to question it. And if maybe I'll get out of it. The same, you look at Kiwis, exactly the same. Kiwi's going to potentially hike 25 or 50 BP, and it's on its lows. You know, the dollar is king and the Fed is king, and you can't ignore that. So yeah, can we find a low in Aussie dollar? We can, but it's going to be more because the US dollar stopped rather than everyone's piling and fancies the Aussie and Kiwi.
Got it. And you know, and the reason why I was asking, and just Dale knows this, everybody, but not everybody knows this that's listening in at the moment. I just listened to my first recording of the Flow show, which was yesterday, and it's really cool. So you guys just be aware, over this weekend we'll be tweeting out all of the links so you guys can listen live, because that happens at 5:30 a.m. Eastern, which is what time? What time is it GMT?
GMT 9:30, BST 10:30.
Yeah, but it's really cool, and it's something that I'm actually really excited about, Ryan, because you know, as a North American trader, I get up early, you know, I have limited, you know, ways to get caught up on what happened overnight. I'm excited for a lot of people that get to listen to your show and get an understanding of what's happening in European trade and how things are moving. So I was listening to that, and that's why I had to ask you that question, because I personally am establishing some long Aussie dollars down here. I'm not sticking my neck out completely, but I am starting to put, you know, little trades on, and I look forward to adding to them. But anyway, we'll have that conversation a little bit later. You know, but I wanted to ask you that since you were talking about it. So Dale, Brian, I'll back to you.
Okay. So, you know, the metals had a negative week. Nothing good you could say about them. Really?
Yeah, it's a familiar picture, isn't it? Looking around, you know, you look at all the charts and they all seem to be pointing the same way, you know. Yeah. And again, you know, it's a lot of this is the dollar.
All one market, and it is centered around the dollar. Everything goes. There's no differentiation. The only differentiation yesterday was, you know, with the yen lower, we had the notes pop, the 10-year yield drop. So that's the only thing that's a little different. And it didn't help the market yesterday, yields coming off, and the market's coming back today. I tell you what, if you're trying to hold a position, I don't care if you're long or short in these S&Ps, you have a stronger stomach than I do when you look at these swings. Okay.
Yeah.
So, you know, I mean,
yeah, I mean, look at that crazy.
Pretty wild. Pretty wild.
Yeah.
So 100 handle ranges in a day.
Yeah.
Every day. So
yeah, bonkers, isn't it? You got to look after yourself.
I mean, how do you know? It's very hard. You can't watch it and be able to hold a position. I would have a hard time watching it. So
if you got a bit of margin in it, then you try. Manage it with stops.
I could
that's
scalp
about the only way you can do it.
I can scalp it, but I can't sit through, trying to hold it with intraday swings like that and, be detached. So
yeah, exactly.
I don't, anyone that could do that, I'll give you a trophy. I must have a Little League trophy laying around here somewhere. I'll blow the dust off it. So, okay, it's Friday. We have to start looking ahead for next week. I know you're a forward thinker, Ryan. What are you thinking for next week with what we saw this week? Does it give you any biases that you want to focus on going into next week?
This week's always usually quiet for data. The week after the non-farm payrolls and such. So we start picking up a bit of the data next week. We start getting the first manufacturing data of the US, the Empire State. That'll come in for May. That gets the ball rolling there. I think we've got a couple of central banks coming up, the RBNZ next week, as mentioned. But before we head to next week, we got the Michigan survey today, the preliminary for May.
Yeah.
Who cares about that? Come on.
Well, usually it's not a big number, but when you get these times when there's not much going on, the market's taking a bit of a pause. Number can be a mover, and it's a consumer number, so it has inflation expectations. So maybe we get to see whether the Fed's message is filtering through to the people on the street. Whether they start thinking that inflation is going to pull back. So for me, watch the main number, but watch those 1 year and 5 year numbers. If they pull back a bit, that might indicate that people are getting the message from the Fed that they're going to contain inflation.
Interesting level. Euro pound is falling. Well, stalled against. Just put this up here, isn't it? So
that's the fib level with the big move from 92.
Yeah, so 82 to 86. If we get breakouts, you're talking 90.
Yeah, well, long way to go for 90. I'd like to see 90 being long. I added to my position this morning 85.05. I've got a short-term zone 85 to 84.80. But that 86 level is, as I say, the 38.2 fib of the fall from the 92s. So a big level that I've been saying for a while. We'll see what happens. I'm expecting at some point.
Maybe.
Yeah, well, we got the ECB. We had De Guindos earlier today. He's, Lagarde's right-hand man said we will be ending QE in July. Not a we may be. It was a we will be. So now that's done. We move on to what they're going to do with hikes. And how they indicate that.
Well, I mean,
what about the Bank of England? The question is, what does the Bank of England do? Because they're kind of torn now, right? I mean, we were thinking 50 at some point. The 50 is out of the question now. They're talking about a couple of members have said already, maybe we shouldn't be tightening anymore. It's like I always try to find reasons to be bullish or bearish a certain currency for the pound. I just can't find a single reason to be bullish at the moment. I cannot.
No, exactly.
Data is bad. Boris Johnson. Let's not talk about Boris Johnson. The UK is very publicly now saying we will never make up again with Putin's Russia, and the Brexit stuff is resurfacing. I mean, anywhere you touch it, it stinks. So,
looks like I didn't look at this before, but 142 to 130 is 12, gives you 118 on this breakdown if you just measure the move before it. So, gosh, we could be there early next week.
There will be a time to be bullish. That there will be a time, but just not now. I don't think.
The one thing with the UK, you don't get sucked into the press. The press is always, fire and brimstone, doom and gloom. The world is ending when it comes to the UK. You never bet against the UK wholeheartedly because we can be quite resilient.
Oh, absolutely. I lived there for 17 years. I've seen how things work, and it's. I agree with you 100%. But at the moment, in the short term, it's just I don't want to touch it. And same still is the case with metals. I've been talking about. I wanted to get to add silver. I'm not touching it. I think we're going to reach 19.5 now. And when we do, I'm going to look at price action and look at a lot of stuff and see what happens. But I'm not touching it yet, Dale. I know you're waiting, so we have to keep waiting.
I put a little bit of some silver shares on yesterday. It's a junior.
Okay.
And a little bit of gold, and I know I'm early, but I bought this one. There's a daily on it, and
especially the junior miners have been absolutely slaughtered. So in terms of value, if you think that the underlying is going to be going a lot higher in the medium term, which I do, then I think it's a good trade. The question is they have to weather the storm when the underlying is crashing. That's the thing. And when rates are rising as well.
I feel more comfortable scaling in stocks, and that this one right here. I have a friend who does all the due diligence, and it's been a great stock picker for a long time. My buddy Jim Fox, and this one you get paid a 4% yield while you're waiting. I know that's not a lot if you breaks another buck from here, huh?
It's better than what you get in the bank.
Yeah,
Hey, remember 4%. We may be laughing about this right now, but that might be what the bank gives you in just due time.
Yeah.
Right?
Maybe.
Yeah. And I remember the day when I could buy a CD and get paid, 3-4%, whatever it was.
Yeah.
That can happen again.
I think the economy is going to be in all sorts of trouble before we get there. If we do have
don't poo-poo on our morning.
How will your 4% bank rate be when inflation's at 10%?
Yeah. Well, I know.
Well,
I'm just saying.
Any comment on the recovery
Dominic
in
says,
crypto?
Guys, Dominic says that's a fraction of what Luna used to give you. Yeah, it's gone down to 0 now.
Oh, man, I hate to laugh about that. Because there's so many people that were hurt. That's true. That was such a Ponzi scheme. I mean, I whether you believe in crypto or not, or blockchain, which I do, but that one specific situation, after reading up on it, I'm like, wait, this is a stable coin backed by another coin that's it's just a confidence game. It was a Ponzi scheme. I mean, if you think about it, it's like
a stable coin, sorry to interrupt, is supposed to be backed 1-to-1 with dollars or with some currency. The end. If it's not backed 1-to-1, it's not a stable coin.
Yeah, it's backed by another crypto, which anyway, I feel bad for the people, because people get sold the dream of this is what it is, and I did I didn't know about it. It's not something I cared to really pay a lot of attention to the dynamics of it before it all happened. But I know you get sold the dream, there are so many. I'll use the word charlatans, right? There are so many charlatans out there pumping their onto media streams, and big ones too, not just like our F.A.C.E webinar. We talk about trading, we're just talking about and no one sits here and tells you, hey, this is how you trade, this is how you make money, right? You make money by doing this, and this. We all have different styles, we all have different strategies, we all we have different methodologies of how we trade. One doesn't mean it's better for me or you, or we just try to give you guys knowledge. But there are venues out there that are like ours, maybe even bigger, and a lot of times much bigger, that you have people like single charlatans that sit there and just pump their ideas, and they're just really just telling you, they're just talking their book, and then you get every day of the week, and then you get failures like this in the system, and people lose it, and it's sad. Anyway. Okay. Hey, we should talk a little bit about what we saw this week in equities. Do you mind if I take the charts, Dale?
No.
Okay. I wanted to show you guys just not the chart that I'm pulling up right now, but that's the dollar max. I just happen to have it on my screen. I'm really looking at the pivot at the 2020 level. This is one of those things that is really defining risk for me. Notice how we continue to fail at the 200-day moving average. I'm very much a bull of Mexican pesos. Whether it's today or tomorrow, or a year from now, I really believe that the dollar Mexican peso is going to break lower in a big way in the coming months. But anyway, that's neither here nor there. Let's talk about equities. And I picked up equities yesterday. I bought the S&P yesterday on the 100, or on the the AB equals CD completion, a little overshoot there. We also hit 127% extension. somebody just asked, and I'm sorry, one of our listeners just asked, did we capitulate? Tony asked if it feels like this is a relief bounce or a capitulation. Let me say this. Do you guys know when the most recent capitulation was? When was the most recent capitulation that you can remember? COVID. Anybody?
You said it the other day, so I'm not going to repeat it.
Yep. Yeah, please. Yeah, don't. Anybody? Ryan, can you remember?
I can't remember what I had for breakfast this morning.
How about this? It was crude oil. Whoops! I didn't. It was crude. It was crude oil.
Oh yeah.
And it was crude at when it went negative. Right. That was what you call a capitulation, right there. When you had futures dropping into negative territory, people didn't know what to do. Markets were crossed. That was a capitulation. So what you saw like yesterday is a little sell off and a reversal. You take like Ethereum, which was my chart of the day yesterday. Everybody's like, oh, there's the crypto, capitulation. No, it wasn't. It was just a little bit of we got Bitcoin that took out some stops below horizontal support and we're getting a bounce. I believe you just sell right into this strength in Bitcoin, right? It's just a little relief rally. And same thing with equities. With equities right now, we're seeing a bounce. I got long yesterday. I'm looking to get out at 40-40, 40-70, somewhere around this neighborhood. And if we get up here, I'm going to get out. It's just, we're just, nothing moves in one direction straight, right? You get bounces and pullbacks. And I mean, if you look at the dollar is still holding near its highs. I mean, this is, I'm trying to sell some dollars here and it's not really working. It's, I'm just kind of sitting here flat in trades that I've been in since yesterday. And that's not a good thing, especially when you have equities that bounce as much as they have. NASDAQ has bounced back. Great. We hit the 50% retracement of the COVID, post-COVID lockdown. We hit the 50% yesterday, bounced like a bat out of hell. Is that the bottom? No, I don't think so. It's just, it's all it is just, I think it's just a recovery rally. Do you guys have any opinions about this?
I'm curious about gold. Blake, you had a harmonic pattern.
Yeah. Since Dale's got some skin in the game here in gold, let's talk about it. And gold is one of those that we just see. This kind of freaked me out today, not yesterday. Today,
yeah.
Here's the 200-day moving average. Yesterday, we pushed below the 200-day moving average, and I was thinking, okay, this is just a push below the 200-day moving average, stopping everybody out below all this technical levels, and then reversal. And I'm like, well, no, we're at the 161% extension. So last night in Asia, they took gold down in Asia and then reversed it pretty hard. And I was like, okay, that was the stop run. Then I get up this morning, or we all get up, and I'm looking around and I'm like, damn, gold is still trading heavy. That does freak me out. If I'm, and then what's going to happen. Dale, you're thinking it. I'm thinking it. Everybody else is thinking it too. All right, fine. If it just breaks below 1810, just get me out. Right. I don't want to be long. And then what's going to happen? It's going to do this. You're right. It's got everybody's number. And mine included, but I mean, that's still what I'm seeing. I'm like,
so the harmonic still could be valid.
I think it still could be valid. Yeah. And you could actually take this down to an 88% retracement, which would be right here. So I think it's still valid, and it's probing some pretty, big levels where it's just trying to, shake the trees, it's trying to grab you by your ankles and shake all that change out of your pocket while you're upside down.
I have experience with that.
Yeah, we all do. So anyway, that's my opinion about gold. And
I'm not as flexible anymore when they turn me upside down.
What's that?
I'm not as flexible as.
No, you're not, and you got less change too.
Less time and less change.
Yeah, gold is one of those. Gold has been one of those anomalies. Like you think about it. I mean, look, I'm bullish at current levels, but how many people have been bullish like for months? And we've,
years.
you know, I mean, with CPI data, with CPI prints above 8% for the last couple months, you know, I mean,
They
who
can't get
wouldn't
paid.
think that the ultimate inflation hedge would be
the dollar.
Yeah, exactly. So you know, it's one of those kind of head scratcher trades that I mean, I can't tell you the number of people I talk to on Trader Summit. You know, I do the majority of the interviews here, and I'm one-on-one with all of these people. And when I talk to all of these people, they're all the same. Bullish gold, bullish gold, bullish gold. And it's like, I know we all look at it.
They're all right. That's the thing.
Well, I wasn't.
They're all right.
The question,
they may all be right eventually.
The question is timing, like we were saying yesterday. Like our friend, here says, sorry to interrupt. Our friend here says gold has been doing nothing for years. Yes, 10 years. It's been basically, you know, it's near the previous all-time highs. But the 5 years before that, it only went up 6 times.
Let's not let's not ignore the fact that since 2019, I mean, it was up almost up like 60%, and it's up 39-40% from there, from 2000, from that breakout point. It is, and it's up near its all-time highs. It's just, you would think that gold would be a lot stronger than it is right now. And here it is hitting new lows.
Well, negative sentiment will take everything in its path. That's the problem that metals have. But, you know, we've seen this over and over again. Look at COVID. I mean, silver hit $12 in COVID, which, you know, given the change in money supply over the past decades or so, I mean, it was a ridiculous level. But when people need to sell, they will sell anything. And unfortunately for metals, they're a liquid market. People, you know, you can get rid of it. And it's one of the first things that people often sell, which is, you know, my opinion is not the right thing to do. But obviously, you know, it happens. So you have to be very wary when people want to sell everything.
Yeah, right. Exactly. Yeah. Yeah. So, well, Dale, you have an interview today, right?
Yes, Dave Keller's with us.
I like David. He's really he's one of the nicest guys. Even nicer. He's also than very smart. Believe it or not.
You know, he's been bearish for a while. I caught David's show. When I was on the final bar, and that was a while ago. So David, you know, recognized a trend shift and has been advising that we're in a bear market for, you know, before April.
Awesome. Nice call. So it's going to be really interesting to hear what David has to say today. But we really quick, I just want to cover a couple other things just before we go. So what do you guys make? Are you guys doing anything or make anything out of crude oil here? I mean, crude is, I had this conversation. I don't know, right? Well, I had this conversation with Chris Weston from Pepperstone the other day, and you know, over the last couple of weeks, actually, we've talked about this, and I'm like, crude is at one of those areas, and you guys remember, you're old enough to remember, all of you, where crude gets to a point where its rally is not associated with risk. Its rally becomes, the market is not happy that crude is up at $115 a barrel, right? You know, when we get to that, I'm wondering if we are at that situation, at that point in time where, you know, crude rallies in crude are going to be met with selling in equities, and vice versa. If crude starts to come down, people will say it's easier on the consumer, because in an inflationary environment, we are now where the rubber meets the road, where now consumers are faced with hard choices on what to spend their money on for a lot of consumers. So because of that, you know, the higher that crude goes up, and you know, the price of gas, you know, RBOB, and you know, and you can even, you know, factor in other commodities, the higher they go up, the more negative impact it's going to have on the stock market, mirroring an economy, if you will. So what do you guys have any thoughts on that before we go?
I was thinking maybe it makes one more run at the highs when the Europeans finally say they're not going to accept Russian oil.
You think that's going to happen? What say you, Stelios?
It's a good question. I still think oil is in by the dip mode until we start seeing strong evidence of basically demand dropping substantially across the globe for everything.
Right, but is that going to have a negative impact on equities?
On equities, good question.
Strong crude is good for equities. It's one of the strongest groups. Oil shares are still making new highs without the commodity.
Yeah,
up until last week. So.
Yeah, if I had to get, I would say it was going to have a weak dropping oil price is going to be.
You're breaking up, buddy, or unless it's me.
No,
it's breaking up.
Oh, it's Stelios. Stelios, you're bald and breaking up. Just in case you didn't.
Right, excuse me. On that point, I want to raise a quick point of order, Mister calling people bald. Yesterday, there was an employment tribunal here in the UK, and the tribunal ruled that someone who got sacked and was called a bald something that was classed as sexual harassment.
Oh man,
wow.
That wasn't me. It was Dale. That was Dale.
I never do that.
That was the full-headed hair Dale that said that. That wasn't me.
We're looking at a
lawsuit. To the cleaners, man.
Yeah. There's going to be a class action lawsuit of the ForexAnalytix team, bald team, versus the guys with hair. That would be me and you, Dale.
Okay. Ryan's, Ryan is crying.
Right. Oh, I love it. K-Man's up in arms. Ryan's up in arms. Yeah. Stelios, I just grab him. I just grab him by the neck, and then I give him a little shiner on top of his head. It's awesome.
All you guys in the comments, you're in for a cut. Okay, so we want your witnesses.
Hey, I want to thank you guys and for the company and the good humor all week. It's been fun. It's been a crazy week. A lot of volatility here. And I want to say thank you to all the viewers who have been listening with us and joking around and, but also, really trying to navigate through the craziness that we've had in these markets. And Dale, thank you for being the steward of the ship. And I know you got one more port to land. Or to dock in before your weekend starts, and that's with Mr. Keller. So I'm going to pass it over to you and say thank you guys, thank you team. Apparently the ball jokes kicked Stelios out already. So you Ryan, have a great one. And I see Grega there. Grega, have a great one. And then Dale, have a great interview with Mr. Keller. Love Dave. So you guys enjoy.
Thank you, Blake. Dream Team, thank you for laying it all out on the court again this week. Welcome back to F.A.C.E, Dave.
Thank you. You guys are kind of clowns today.
I think it's
daily, Dave. Daily, daily. We are.
It's a coping mechanism, Dave. Humor kind of takes the edge off.
You have to laugh in this sort of environment for sure.
Yeah. So, like I said before you came on, David, I remember you had a negative view of the market.
Yeah.
Before the big selling coming in April, which, I thought it was great. I was talking to someone else who uses seasonals, and April was supposed to be a very positive month for the market where seasonally risk on, but it just goes to show you can't depend on just one thing like seasonality, or just one thing, the 200 and the 50-day. It's just another tool. And so, I'm glad when some of these tools don't work so that people learn that they have to do the work. And it's not that as easy as, it's a bullish month for risk. And just get long.
Yeah.
So
and particularly newer investors, I think, struggle. Their goal early on as a trader is to find that one thing, right? That thing where you just you can relax and just watch this one chart or this one indicator, or this one tell, and then it's easy. And I will tell you, as you know as well, Dale, that it's not there. There's a lot of nuance to it. So over reliance or oversimplification ends up not being a great strategy. And this has been a humbling experience, a humbling 2022 for a lot of traders, for sure.
Yeah, buying the dip. Which they've been programmed for
that's right,
a decade, at least.
Yeah.
So what are you seeing here, Dave? Are we approaching some type of targets? I know a lot of people talk about this 38-ish area, 38% retrace of, from the COVID low to the high that we had this year.
Yeah.
You think that's going to be enough for at least a bounce? We almost got there yesterday, didn't we?
So I was going to say we're within a rounding error of that 3,800 level. I mean, on my chart, I'm kind of keying in. It's around 3,815 or so is the actual level. That's if you take the March 2020 low and then the January 2022 high, that would represent a 38.2% retracement of the way down. And a lot of people pay attention to these levels. It's not just, my chart, but this is a pretty common technique in the technical community. So, if you took September 2020, which was sort of that big congestion phase, September, October of 20, before you had the rally that led into 2021, 38.2% of the way down of that was right here around 4,200. And we spent about 10 weeks kind of bouncing off of that level. So these are important levels that people tend to pay attention to. And I've heard it from a number of my peers in the industry to the point that I would say, as we get closer to that level, I would be banking on a meaningful bounce, but I would continue to think of it as you should be thinking of 2022 so far. This is a market in distribution mode. And I think, bounces are tradable bounces, but that's it. I think if you're looking for bottoms yet, you're probably a little too early. And you had mentioned it in the introduction, which I appreciate. The signs that we have been talking about with our viewers are, really started in November. That's when most things kind of topped out. That's when breadth topped out, momentum topped out. The NASDAQ, a lot of things did not make that new high in January that the S&P did. And so there had been signs of deterioration even in the fourth quarter of last year that have just been, continued to be reinforced through the course of this year. And I'm not seeing any meaningful improvement in those things that suggested the top going into the beginning of the year that would suggest any meaningful bottom yet, right?
Yeah. Okay. Well, you've had a little pullback in yield here, Dave. Do you think that's, the 10-year has pulled back about 40 bips and now it's trying to pop a little bit. And a lot of this has been interest rate pressure. Yeah. So I think that the hook might be everyone thinks if yields start to come down, that all is clear. But perhaps what it is a move into flight to safety, even though all the way down, both stocks and bonds went down together. In fact, the bond bear market led it. Could there be, people saying, not a bad yield for a 30-year. I think I'll buy it.
So that is absolutely the case. And I listened just a little before you and I started talking about, the dollar with the incredible run that you've had with, interest rates going up so quickly. So in any sort of environment, what you learn as a technical analysis is to focus on extremes, right? There are healthy patterns or sort of consistent patterns of accumulation. And maybe the energy sector is a good example of that, like a chart like, Devon Energy, which is this nice, consistent uptrend. And then there are charts in clear distribution phases and things like communication services, kind of stocks like Disney that have just been in these downtrends. But then there are also, you're also trained to find extremes. Like at some point when a trend persists, it gets to the point where people start realizing, okay, hold on a second. The dollar's gone up a ton. All right, hold on. Bonds have gone down a bunch. At some point, just the valuation, just the cheapness or the richness of something will compel enough people to either take profits or to jump in. And I think you're right. I think as the equity markets become a lot more painful, I would still argue there are people that are still thinking buy on dips here for some reason. And at some point, I don't think we're firmly in that disbelief phase or in that, we're in the disbelief phase, which is, the market goes down and you don't believe it can go much lower. When, a true bear market is where there's this acceptance, sort of this, dismal acceptance where you recognize, okay, things just aren't going to improve for a while. And that's when you see people rotate into safe havens. And the fact that rates have spiked up to where they were in the end of 2018, which is around 3.25, that's the chart we have here. The fact that the dollar's had such a run, I think it's totally reasonable to expect a pullback in the dollar, to expect a bounce in bonds and a pullback in rates. But I would be thinking of those as counter trend moves within this longer phase, which I don't think is probably over yet.
Okay. And you know, with rates coming down, a lot of people say, well, I'll buy the semis because, you know, and actually the semis seem to be a group that has been, as of late, showing some resilience. Are you getting any kind of signals that they're at least due for a bounce, SMH?
So, and I would start, I'll bring up the chart of the SMH in a second. The second panel on this chart, I think, tells you a great deal about why rates are so important for the question you just brought up, Dale, which is, you know, if you look at value stocks versus growth stocks and compare that to the chart of the 10-year, it matches up pretty well over the last couple of years. And, you know, and again, you know, 6 months ago, it felt crazy to think that, you know, FANG stocks would just be cratering and energy stocks would be ripping to the upside, but that is indeed what we've been seeing. And that's a pretty classic move, given the fact the rates are going higher. It's just, and you had mentioned with seasonality, I don't tend to think of things in absolutes. I would tend to think of them more in terms of headwinds and tailwinds. So you have to remember that if rates are going higher, that's a headwind for growth stocks. It's just not a great environment because their growth prospects don't seem as attractive when you have rates going up like that. When rates come down, that's when it ends up being a better environment. So a counter trend move, if you see rates come off a bit, if you see bonds rally, I could certainly see semiconductors coming up. And in the chart of the SMH, it's lining up really well with sort of that second quarter of 2021. This is a nice big run into the beginning of that year. You sort of had that consolidation pattern before we resolved to the upside, and we're kind of retraced 100% back to those lows. So it's a reasonable place. You could expect a bit of a bounce here. So I think that's when I'm looking at stocks that overall I still think feel fairly weak in terms of the major indexes. Semiconductors have come off quite a bit, 100 points on the SMH. Tradable bounces should be expected. I think we're nearing the point where that's a likely scenario here. Okay,
and the miners have been decimated. Gold broke about $250 and silver. So what do you do with this?
So I was taught earlier, one of my analysts in my Fidelity years we'd bring up a chart like this and he would say, this just doesn't chart well. And sometimes charts make a ton of sense. And I would argue like the charts of energy and others, have been fairly consistent. Arguably, even the S&P has made a lot of sense when you think about this rotation from, optimism to pessimism or accumulation to distribution. If you look at the GDX, we're at the same place we were 2 years ago. Right? There's a 2-year chart where we've gone nowhere. This is a big consolidation phase. The chart of gold has come off quite a bit. And, a lot of people think when inflation is a huge problem, that obviously gold is going to work. And I've certainly been guilty of that as well. But you have to remember, it's a little more about real yields, right? It's about real rates. It's not just about the nominal rates, what the 10-year yield is doing. It's what that is relative to inflation. And if you look at like the tips, for example, they're sort of in a pretty good downtrend, and that's why gold is going to go down. Gold's denominated in dollars, so if the U.S. dollar is doing what it's doing, it's hard to expect gold to rally from here. So at this point, if you're buying gold stocks or if you're buying gold, it's a mean reversion bet, assuming we're at the lower end of this range, and it's probably come down enough. I don't mind that outlook. I think that's a reasonable expectation. So it's interesting with a lot of these charts, they've had really good runs, and I always talk about mean reversion, right? There's been enough of a run that enough people recognize there might be an opportunity, and you get a bit of a reversion to the other side. And the danger of that, by the way, not to completely go off the rails, but the danger of that thesis is something like cannabis stocks, which have just been in a downtrend consistently. So just because something has gone down a lot, that on its own should not be your investment thesis. So if you hear yourself saying, I should buy blank because it's gone down a ton, that is a bad thesis. Right? If you can support that with other things, as in it's reaching support, there is some macro thesis that would allow you to for it to bounce higher. I think that makes sense.
Can you think of one fundamental or technical reason to buy this chart?
So not really. I mean, I think in terms of the fundamental reason, I think it's a long-term thesis. I think if you're buying cannabis here, you're buying it, you're probably buying Bitcoin as well. It's, you buy into the idea of blockchain and you like the long-term opportunity, and overall you're probably getting in at a fairly low price. I could get that argument. I own cannabis in a retirement account because I'm not planning on touching it for a long time. And I think at these levels, that is a reasonable long-term bet, because you see the potential there. But from a purely technical perspective, no, this is not the type of chart you'd want to be buying, because for me, I'd be looking for signs of accumulation, right? Signs that buyers are coming in.
Got to stop going down first. Right?
Don't confuse the bottom of the page with support, is what I was taught early on. I think that's absolutely right. There have been a number of times when you could argue that cannabis had gone down plenty, and it never really reverts. You need to see that reversal, and on ETFs like YOLO or MJ, and the bigger names like Tilray or Canopy Growth, and you're not really seeing those at all yet.
I suspect that the difference, or do you differentiate between the U.S. cannabis companies and the Canadian?
I've become, since moving to the Pacific Northwest, where cannabis is a lot more part of the conversation, I've become a little more fluent in the language and where it's at, and absolutely. So I mean, the U.S. market obviously fairly underdeveloped and fairly fragmented, and in Canada, you obviously have a lot more of a public market. You have a lot more of a secondary market to pay attention to. So a lot of the ETFs, a lot of the names you're looking at are Canadian names, but still overall not a great space from a technical perspective.
Okay, and I can't think of another space we haven't covered. Anything you want to wrap it with? You probably came in here with some ideas and I distracted you.
No, no, not at all. I mean, I would, and again, I think if you're looking at this, I'll share a couple charts of that. First off would be, a classic technique to sort of figure out where a bottom might be. And I'm often asked in this environment, just like when the market was moving consistently to the upside, right? Where do you know the uptrend is over? And the opposite here, I will give you 3 charts that I would be looking at to determine when a bottom might be. The first one's this one, and this is called Dow theory, and this is what I've adapted Charles Dow's work from 100 plus years ago. It's what I call a new Dow theory. It's looking at the S&P and the NASDAQ composite. So the S&P representing the old economy, the NASDAQ composite representing the new economy. If these things are both making new highs, as you saw in November of last year, the trend is positive, right? The old and new economy all sort of moving upward together. When one of them makes a new high and the other one does not, which is what you saw at the end of last year, that tells you, it's called a non-confirmation. That tells you that part of this story is not continuing to play out. So the old economy making new highs, the new economy failing to confirm that. Then you get a bearish confirmation when both of them start making new lows. And in the last couple of weeks, we've gotten yet another bearish confirmation. So, if you ask me, what would I need to see to be less bearish? I would want to see one of these making a new low and having it not confirmed by the other one. And as you can see, this week gave you none of that. It gives you more of a bearish confirmation, telling you that we're not there yet. So at some point, one of these will most likely make a new low.
Back over 4,100 would give you a little bit more confidence in the S&P.
That's exactly right. And so at this point, it's telling me, as opposed to be looking for a bottom, it tells me to be bracing more for a risk-off environment for a little bit. The second one I would say would be looking at this chart. This is the percent of stocks above their moving averages. So we're looking at the S&P 500 here at the top, and then we have the percent of S&P members above their 200-day moving average, which is currently around 30%. The percent of S&P stocks above their 50-day moving average, which is currently around 17%. So while there are bright spots out there, there are places like energy and consumer staples, right? Things like TAP that are having these nice rotations higher, which I think are decent bets in this environment. The average stock is struggling, right? And so you need to see breadth indicators like this turn more positive. And I heard you or Blake or someone was mentioning capitulation. I heard it as I was bringing up the Zoom room.
People just like to say it.
Yeah, it is a fun word, right? If you think about it, though, when you think about capitulation, that's like, I mean, for lack of a better phrase, it's sort of this puking out. It's like the last seller has now sold and no one else is left. And so all of a sudden this buying can just come in, and buying pressure can sort of overwhelm things and push them higher. If you look back at like 2008, 2009, you can see that this indicator at the bottom, percent of stocks above their 50-day moving average, often gets down to 0 and sits there for quite a while because literally everything's going down. The percent of stocks above their 200-day in major bear market phases has gone down to single digits and even to 0 at times as well. So while it feels like they've gone down a lot, which they have relative to the last year or two, if you look at bear market phases, they're not even near the point where markets have bottomed out before. And that's when sort of everything's coming off. When people don't even want to buy an energy stock because they don't want to buy an equity at all, that we're not there yet. And I think if we would get to that point, that's when you'd see these indicators really capitulate. And I don't think we're seeing it yet. The last one I would put, and then I'll be done, is this one. This is looking at the relative strength of consumer discretionary versus consumer staples. Wow. It reminds you a lot of the S&P and NASDAQ charts. So here we're looking at cap weighted, the XLY versus the XLP. At the bottom, we're looking at the equal weighted versions of those ETFs. You mentioned how I've been sort of giving more of a bearish take on things. And that really started, earlier this year, because if you look, these ratios both topped out in November. That's the last time they were confirming that the trend was healthy. From there, it's been the relative defensive staples over the relative offense of consumer discretionary. Both of these ratios have made new lows again in May. I mean, 12-month plus lows. These would have to stop going down for me to be less negative on the overall trend at this point. So all of those sort of major indicators, the major index trends, the offense versus defense within consumer, and the breadth conditions are not suggesting a bottom yet. So, and that's why I think bounces at this point, you think of them as tradable bounces. Those are bounces to be sold, not bounces to be buying into, because I think there's still a lot of negativity that has been yet to play out, most likely.
And what's different is, at least in my experience, unless I'm having a memory issue, these multi-hundred handle swings within a day for the S&Ps. I don't think I've ever lived through that, and I've seen a few things.
Yeah, the volatility is not going down, right? The VIX is sitting comfortably above 30.
Okay, so that's a question. Why is the VIX stuck, it feels like, neutral or grinding, while the market's a lot lower? VIX hasn't really caught fire yet.
Yeah, so
it's orderly.
I tend to think of volatility in terms of volatility regimes, meaning there's a period of time where the VIX settles into a certain range, and then things change. And if you look at the last couple of years, you can define the phases in market activity by the ranges, right? So 2009, relatively low. You have the big spike in February, March, where the VIX got above 80 for the first time in a very small number of observations where the VIX is anywhere near that level. Then you kind of settled into this elevated VIX with between 20 and 40. Then all of a sudden, middle of last year, things got really straightforward. The S&P in a nice uptrend, volatility very low, the VIX between 15 and 25. Last 6 months, now we're in a new volatility regime where it's really 20 on the lower end, 30 on the upper end, right? So if you just over the last 6 months bought every time the VIX hits 30 and sell every time the VIX hits 20, you did pretty well just trading these bounces. I would argue we're in the process of creating sort of a new volatility regime. I wouldn't be surprised if it starts to look more like maybe the second half of 2020, which is elevated volatility, bigger price swings as people are trying to make sense of things, as people, start to embrace the fact that we're in a downturn. This choppiness in the elevated VIX is people not understanding how bad this could get and starting to think about risk assessment. And
they will on closes over 40.
Well, I was going to say, right, at some point it starts. I mean, I think the VIX gets above 40, which is the purple line here. That's when people really start to, I think that's when you get to this acceptance phase, when people sort of get in the fetal position and get really defensive, where it's not happened yet. But it's getting closer. And I think the VIX might be an interesting chart to watch. The fact that it didn't just go right down after it broke 30 and that was it, tells you the fact that this is most likely more of a sustained move to the downside.
David Keller, everyone. And this is a guy who was not a perma bear before things shifted. David, and he's not a revisionist, where, he doesn't forget what he said if it didn't work out. So David, best place for people to follow you besides Twitter at DKellerCMT?
No, I appreciate it so much, Dale, and it's awesome to be on with you. As always, it's a pleasure to chat with you, and I hope I can get you back on my show here at some point. I host a show called The Final Bar on Stock Charts TV. It's the closing bell show every day, and I welcome you guys visiting me there. And then marketmisbehavior.com is my website.
Yeah, that's the naughty side of Dave. All right,
it's the naughty side of your investment process.
He goes from the bar to misbehavior. So, so anyway, you may think David's a choir boy. Anyway, David, really appreciate you being with us today and sharing your views here. I highly respect your work and your giving spirit to share it all the time with people. So
appreciate it, Dale. Have a great weekend. Thanks again.
I root for you, bro. So have a great weekend, and I'll contact you on Twitter, and we'll keep things going.
Sounds good to me.
All right, David Keller, everybody. We're in a bear market, but you could trade both sides, but realize that they're bear market rallies. That's the takeaway. And have a great weekend. Don't just worry about your P&L. Enjoy the people you care about. Tell them how you feel. Recharge your battery. And while the markets are closed, get your plan together for next week so you're not just reacting to the market, but you have a plan to react to. So that's a wrap, everyone. Cheers to you, Darren, Dave, and have a great weekend, everyone. Don't just count your pips, count your blessings. Adios. You too, Paul, Sinatra, all my trading warrior brothers and sisters. Thank you for hanging out with us. You're welcome, Paul.